Hello and welcome to WhatKeepsYouAwake.tv. I'm your host, David Hooser, and have the great pleasure of introducing our guest, Mark Briden.
Thanks, Dave.
Mark has been a busy man serving as CFO for one of the fastest growing Arizona companies since 2023. Add in his history of managing SMB turnarounds, and he is undoubtedly a perfect guest for our audience. So with no further ado, we welcome Mark Briden. Let's get started with a foundational question for you, Mark. As a corporate, let's say cowboy, with a history of reining in SMB owners, what keeps you awake late at night?
Cash flow.
That's a doozy.
Always need to understand cash flow in your business. If you don't, could be a dead man walking in no time.
Cash flow is a big reason for the topic today on, when to get funding as a small business owner, small, medium-sized business owner. What are the kind of reasons you would consider funding as a small business?
I mean, the best one is always during growth, right? So when you foresee a large increase in revenue or growth opportunities or expansion, typically capital is always required, right? So you need to be ahead of that because you don't want to miss the opportunity.
So
right?
Growth is you're anticipating growth, because if you have it, if you're in it, you have the cash. But you're saying,
well, if you're in it, you could potentially miss out on greater opportunities,
even bigger
right?
growth.
So when I look at it, and when I'm in charge of an organization, talk about a manufacturing company, for example, which I ran for about 7 years, had to anticipate the growth of the industry.
Okay.
Right. So had to stay in front of it. You have to buy equipment in advance, which it has a long lead time, which means you need to get the financing well in advance of the industry taking a big jump or a big boom.
The growth spurt.
So always have to anticipate it. Always need to be in the market very deep. Even as a CFO, you need to be talking to the sales reps, the industry leaders, understand all of that. Because if you don't, you'll miss the boat. And then your financing, even if you get the financing, might be too late.
Gotcha. So timing that financing in advance
Yep.
for the growth that will come.
Exactly.
Based on the inputs that you're getting, the signals you're getting from the industry. How about cash flow then? That's how do you get that?
So cash flow, once you start growing, typically your inventory or your receivable starts to grow as you start to expand, right? Which means that you need more cash up front to provide a bigger, better service or more services or more products to the customer, which causes on the expansion, it causes a very significant cash crunch.
Right.
However, on the flip side, when you shrink a business, you have a significant cash inflow because you're not spending as much cash on the downside. Therefore, you'll be able to wind down that loan if you have a loan.
Gotcha.
But going back to the growth, anticipating the cash flow, as you see it, typically what I'm doing is I'm looking for an asset-based structure, ABL loan, asset-based loan, and that's typically derived from your accounts receivable, which you could easily leverage or factor if you need to, or inventory. You get a smaller advance rate on your inventory, but your receivables is where to start. As long as they're clean receivables, they're good. They turn. You could collect on your receivables within 30 to 60 days. You should be able to get an asset-based loan somewhere in the 80 to 85% advance rate. So
assets, you're talking hard equipment. So you mentioned inventory, which could be an asset, which is an asset.
Inventory will
equipment,
inventory and equipment will be lower rates. Equipment might be anywhere from 65 to 80%. Inventory is typically in the 50 to 70%.
Got it.
right?
Okay.
So inventory, they don't want to give you too much credit for your inventory just because they don't know how long it's going to be sitting there.
Gotcha.
So
How about, one of the things, almost everything kind of goes with growth, but everyone's talking about AI right now, and we're looking at huge budgets for technology improvements. How is that from a funding standpoint? Is it something easy to fund, that kind of technology upgrade?
well, I mean, if you're investing in CapEx, talk about equipment, whether it's data centers or buildings. So those are hard assets, right? So when we look at hard assets, I classify those as either real estate or equipment. Equipment, you'll be able to go get a loan on equipment, not a problem. Typically, a 7-year amortization on a loan is pretty reasonable, either 5 to 10 years maybe in that range. Real estate, if you're building a data center, I mean, if you look at some of these large organizations, they're spending billions and billions of dollars, and
But you have collateral in that
there's
case.
collateral, right? As long as there's collateral, it's good collateral. It's sellable, or you can liquidate it, or you convert it to cash quickly.
Okay.
Then there's a easy ability to get a loan for it.
And then, so we go back in talking about growth. You just see a market opportunity. Can you fund? How is that a reason to fund if you're a small business?
Well, most small business owners are risk takers.
Are all seeing all kinds of market opportunities.
Yeah. But most small business owners are risk takers, right? So, and they know their business better than a lender will. So most of the time, you're going to need a little bit of that equity to put down for that initial growth. You kind of have to take that first risk, first loss risk, and then the lenders will follow shortly after that. And it's straightforward. If you have a good finance team, or even if you don't, most small businesses don't have a good finance team. They should reach out to their trusted advisor, and I think that's probably their CPA.
Right.
If it's not their CPA, you should be looking for a good finance group, small group that will help you with projections, and will help you with obtaining a loan. Have those conversations with the lenders, negotiate the term sheets, and then ultimately get you to a closed deal.
So what about unexpected expenses? Are those, do you look for funding in that situation if you need it to get through a crunch?
Unexpected expenses. Typically, what I do is I go to my restructuring playbook. Number one, start looking for cost-cutting opportunities and reducing expenses. Lenders will probably not give you money for issues like that unless they are secured. And what I mean by secured is there's assets in the business that are not currently leveraged, or there's additional collateral that they can lend and give you additional cash resources for.
So again, it comes down to having something of value that you put up against whatever funding you're seeking and whatever source you're seeking it from.
Yeah, typically in those situations, you're going to be looking at a higher interest rate, right? You'll be looking at alternative financing lenders. So when I talk about an asset-based loan, if you're a very good company, let's just call it a $10 million revenue company with good receivables, you should be able to go to a bank and get that type of loan, or
against your receivable. Against your receivable. The asset. Okay.
If you've already done that, you already have a loan, and you're having some issues with that availability, they call it a borrowing base. That's how they determine the calculation of how much money they will give you. If you're running out of availability on that loan, typically you'll look at an alternative lender, which will give you higher advance rates on your collateral. But again, it'll cost you more in terms of interest. Right. So it all depends on the risk factor and the rate that you'll be able to get.
So let's talk about some of the risks when you go into a financing situation. What are some of the top risks in that scenario? So, I mean, obviously you're leveraging your equipment, your
I'll give you an example that I had to deal with back in 2020. 2018. 2018. I was in the commodities business selling steel, manufacturing company, and our primary product was inventory, steel.
Right.
It was a commodity, right? So the price of steel fluctuates daily, every day. And then there was tariffs that were put on your inventory and steel coming in from outside the country.
Right.
So the tariffs were specifically put on steel in the early, I think it was March of 2018, and it caused a significant cash crunch for my business.
Readjustment of the value.
So I had a large backlog with specified pricing to my customers. My margin eroded quickly, which means we lost millions of dollars from that backlog, and then we had to replace the inventory with more expensive inventory,
with higher cost inventory.
Right? So it caused a cash crunch. So what are the risks when you take on debt? You got to repay that debt, right?
Well, and we're in a time right now where tariffs are being mentioned on every newscast, right, with the new administration. So you've got to be thinking.
Need to be prepared. So, a lot of businesses are looking at increasing their inventory as of, in the early days right now. They're placing those purchase orders with their factories, whether they're overseas or wherever they're at, in anticipation of higher pricing, right?
Okay.
So, you have to be concerned about the over leveraged and being able to repay that debt and that principal and that interest.
And just because a lot of the audience in this program, in this podcast, is small business. I mean, what kind of guarantees are they having to make on these types of loans?
Early days or early companies, newer companies. Typically, the banks are asking for personal guarantees.
Yeah.
I've been in restructuring for a while. Large loans. I've never seen a bank exercise that guarantee clause. I'm not saying it's something to be concerned about or not concerned about,
right.
But I've never seen it exercised unless there was wrongdoing.
Gotcha. Good
so
point.
Early days, though, they do ask for a personal guarantee. There's homestead exemptions, so most of you should be cognizant of that they're not going to be able to take your home if you default on a $500,000 loan from Chase Bank, right?
Right.
Just not going to happen. However, a predatory lender that has a 25 or 30% interest rate, an MCA lender, merchant cash advance lender, I don't know. Maybe they will.
Okay.
Right. However, I don't think those are going to have personal guarantees associated with them.
And which is the reason you would consider that source, right?
Correct.
Is because
it's
much higher interest, which is hard to pay off. Right now, I think just on the personal debt side, I saw the highest number of consumers paying their credit card debt are paying the minimum amount.
Yep.
And when you pay the minimum amount, you never pay off the debt
default rates for credit cards are starting to rise to be higher than they were pre-COVID.
And I've seen that bankruptcies are reaching a high as well again. So a lot of things to be worried about with the risks of taking on these obligations. I mean, there's always, and like you said, we're a risk on, individual by definition as an entrepreneur. So we tend to believe we can make this happen, but there are the downsides when you take on the wrong debt, the wrong kind of debt. You leverage the wrong asset in your company. So
so early days, again, you'll probably have a personal guarantee. As you get further into the relationship with that lender. Typically, after about a year to 2 years, I would start asking for that guarantee to be removed from the loan docs.
Gotcha. With a track record of payment.
Correct. Yep. So that's typically one of the first things that I ask to be removed.
Okay.
Right. And then I start asking for an increase in advance rates, specific.
So is this like a line of credit?
An asset-based loan is typically a line of credit, right? Say you'll get a $10 million line, but your assets are only good for $8 million. They'll only give you an $8 million loan, right? Okay. But as you grow and your assets increase and decrease and increase again, and say you have enough availability on your line of credit to use and use that entire $10 million, that money's readily available.
All right. Well, good. Well, I want to close it with, if you have what I call a shameless plug on your business, we'd love to hear more and let everyone know, how to find you online.
Yeah. So our firm is 360advisor.com. It's the number 3 and then 60advisor.com.
Okay. We'll put that up on
we do taxes, bookkeeping, we do financing, we do health insurance, general liability insurance for your business, whether it's real estate or pretty much all aspects of office of the CFO. So typically small business owners, they have 5 or 6 different trusted advisors, right? They're different brokers, they're bankers, they're attorneys, they're CPAs. We try to bring that into one house to act as your trusted advisor, all within one organization.
All rolled into one. Great idea.
So you can get your health insurance through us, your traditional insurance for your business.
E&O if you need
D&O, property insurance, property and casualty insurance, and then your tax returns. We help with cost segregation studies when individuals buy their investment properties and they want to take advantage of some tax deductions and tax savings. So we help with that, tax planning. Ultimately, we're here to help a small business owner succeed, and that's what we do for a living here.
So we have to thank you in advance for letting us grab Ron Whaley, who's coming on a future episode to talk a little bit about legacy planning. So again, we're in this for a reason. Why we're building, value in our businesses. Then what do we do if we reach our goals?
Sell it. Or you pass it along.
We need to have a plan.
You need to have a plan.
All right, guys. Thanks for tuning into this podcast episode. We'll see you on a future WhatKeepsYouAwake.tv. And don't forget, follow or subscribe to our show. Thanks.
Thank you.